What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and as you saw in the title of this video, I've just backed up the truck. As of yesterday, November 30th, I have put 90% of my equity portfolio into gold mining stocks. And so today on this video, I'm going to break down for you, number one, what prompted me to make that decision. Number two, what my time frame is on this trade, what's my exit point. And number three, what I did to protect myself just in case I'm wrong. Ready? Let's dive in. All right, before I jump into the details, I have to tell you, obviously, if you've been around the channel at all, you know already, but none of this is advice. Don't consider any of this to be an individual investment recommendation. Obviously, I don't know you, so this is just what I did with my portfolio, meant to be for educational purposes only. Now, I have three main kind of portions to my overall portfolio. One of those big portions is real estate. Didn't touch that. Another big portion of my portfolio is physical gold. That's the savings or the money side of my portfolio. Didn't touch that. So what I'm talking about here is the equity portion of my portfolio, the stock portion of my portfolio. So of my stock portfolio, of my equity portfolio, I've got about 90% in gold mining stocks. All right, so there are a few reasons that prompted me to make this change to over allocate into gold mining stocks as of yesterday. And the first reason is largely technical. And so if you look at the gold miners, you can see that for the most part, most of them, a good proxy would be GDX. If you look at this chart, this is a very common gold miners index. So you can see that it has been inside this bull flag since August, right? And so it's been consolidating, moving downwards, and it's stayed locked inside this channel. Now, over the last few trading days, there was a false breakout where it fell down outside of the channel, fell below the 200-day moving average, and it is well above the bottom side of the channel. Now it came back in, it was a false breakdown, and it closed above the 200-day moving average as well. Now, normally on a move like this, in a channel like this, you'd expect the next move to retest the top of that trading range again. You can see every single time it bounced off of the bottom of this trading range, the next move was a swift move back to the top of this channel. Now, obviously, miners are largely driven by what's happening to the price of gold as well, so it's no surprise that the price of gold was making similar moves during this time frame. Gold as well hit the bottom of its trading channel, and itself as well is now back above its 200-day moving average. And so suffice it to say that both in gold and in the miners were experiencing a lot of support here, and there was a false breakdown, which usually shakes out some weak hands and provides the steam and the momentum that it needs to have a new rally begin here. Now, the second thing is the strength, the relative strength index, the RSI. So the RSI is an indicator that measures whether something is oversold or overbought. Both gold and the miners have not been as oversold as they have been for the last few days since the bottom of the market in March. And we all know what happened to gold and the miners from the bottom in March to the top in August. Now, why miners then over gold? Because if gold is making these moves, wouldn't physical gold just be a safer bet than miners? Well, yes, it would be safer because miners have leverage associated with them. And so if you look at the move of what miners do compared to gold during an upswing, during a bull market, miners move up to a greater degree than the actual physical underlying. And that makes sense, right? Because the price of gold determines how profitable these mining companies are. So if the price of gold goes up, that's going to have a leveraged effect on the profitability of these mining companies. And so you can see that many miners more than doubled from the bottom of the market in March to the top in August, and the price of gold went up about 40%. Now, the problem is this leverage works both ways. And so the price of gold from the top in August until about now has sold off about 15%. Whereas most miners have sold off a lot more than that, like the GDX is down about almost 30% since its high in August. So we've got a couple of factors coming together for us here. Number one, miners have a leveraged move associated with them compared to gold, the physical price of gold. And so if gold moves up or down, you're going to see that move to a greater extent in the miners. Then number two, we have both gold and the miners being historically very oversold, and the last time they were in this territory, they had a huge rally following. And then number 3, I'm looking at the fundamental drivers of the price of gold turning around the recent correction in the price of gold and us resuming an upward bull market in the price of gold. Now, I just recently made a video about the fundamental factors driving the price of gold right now, and that video is titled Gold Price Breakdown is Now the Last Chance to Buy. If you haven't seen that, go and watch that because I'm not going to detail everything here, but bullet points, the number one driver that's driving the price of gold right now is the bullion banks. It's the trading desks, the gold trading desks at the banks, and they are massively short right now, like 38 billion. It's at a record net short, and these are naked shorts, and so there's not enough gold in storage to deliver on these contracts, and so they're trying to hammer down the price so that they can close out at as little of a loss as possible. But when you close out short contracts, it's a buy to close those contracts out, so that drives the price up. And we're starting to see very similar dynamics in the physical markets right now, where there are big shortages of the physical supply right now that look almost identical to what they looked like in the beginning of March when the gold price and gold stocks were getting hammered pretty hard. If you go to acquire any large amount of physical gold right now and request delivery, there are big minimums and long delays before you can actually get your hands on the gold that you're buying. Not only that, but the physical prices are much higher than the spot prices. And so we're starting to see a big short squeeze build right now, to where once we break out in this gold price here, we're going to see an epic rally in the price of gold, because there's just going to be a massive squeeze going on behind the scenes. There's not enough supply to be actually sold to keep that price down anymore, and the market just essentially skyrockets up until the price gets to a point where sellers are willing to come back in and sell the supply that they have. And so this massive rally that I'm expecting to see start to happen any day now in the price of gold is going to directly translate to a leveraged move in gold miners. Now, you know by now that I almost never take a position unless I am close to fully hedged. And on this position, I'm actually about 150% hedged. And so if I'm completely wrong about this and we see a further breakdown, let's say there's a deflationary death spiral start to happen and debt starts to collapse and the asset prices around multiple sectors and industry just start to collapse, and we have a huge economic contraction, money printing stops, or money printing stops being as effective for price inflation as we've seen right now, and we just have a big collapse in gold miners, I'm going to make a big profit on that as well. Not nearly as much as if we have the rally that I'm expecting, but at least I'll be profitable on that. So in a situation like this, where you've set yourself up to profit on a big move up or a big move down, what is the downside? Where do you lose? Well, you lose if nothing happens. And so nothing happens to the price of gold, nothing happens to the price of miners, and it just kind of consolidates and just kind of drifts along here at the prices that it's currently at. That's where a position like I'm in right now really starts to lose. And so since this is an anomaly, this isn't something that I'm doing for a long-term, a year, 2 years type of play. This is a move that I'm expecting to be swift, fierce, and to start any day now. So I'm watching this very closely, and if I'm wrong, I'll know in the next couple of weeks if this trade is not going to pan out the way that I expect it to. And so I'm not going to be sitting around on this for months waiting for this to play out. I'll reevaluate my position as I go, and if I need to, I'll pare down, because yes, I think this is going to happen, but I'd rather be profitable than be right. Now, I know the number one question is probably going to be, which specific miners did I buy? And really the main reason why I don't list my individual holdings or my specific miners or any investments that I've chosen other than the broad categories is really because I want to stay as far away from possible from any legal allegations of pumping and dumping. If something changes the day after I say, hey, I've invested in this and I have to sell it, I don't want to have to deal with that. So I'm as transparent as possible while still staying on the right side of potential litigation, because I never want what I'm doing here to come across as advice or me trying to get somebody to make some sort of investment that would allow me to get out of it to where my actions aren't lining up with my words. So because of that, I don't list individual positions or holdings that I have. But for some guidance, if any of you are wondering how to get into miners, the number one thing that I would say is you have to treat them like stocks. This is, like I said in the beginning of the video, gold miners should not replace a physical gold allocation. Physical gold is money, it's savings. Miners are investments, they're stocks, and they should be treated as such. And so if you don't have any ability or background or skills or experience with researching and evaluating the value of a company, that's what you have to do when you're getting into miners. So if you aren't able to do that and pick miners specifically for real reasons like that, then there are lots of people who do that. Just your regular gold mining mutual fund, active gold mining mutual fund, will do that for you. That's what active funds do. You can also use an ETF like GDX, which is just a passive index basket of gold mining stocks. GDX is just an example. There are lots of ETFs that are baskets, that are passive baskets of gold mining stocks. And the last thing I want to note is that every time I talk about gold mining stocks, inevitably there are at least a few people that say, hey, I've been investing in mining stocks as my gold position. And so now that we've talked, it sounds like I should have, a separation between the two. And that's true. And so if you don't have a physical allocation to precious metals, to gold, and you don't know where to start, I really like OneGold. You can do auto investing. You can store allocated gold. You can choose where in the world it's stored. If you don't want it to be stored in a certain country for political or legal reasons, you want it to be stored in another country. And then anytime you want, you can request physical delivery really easily just from the website. They've got a great user interface, great prices. And if you sign up with my link in the description below, you'll get a free $5 to help you out starting off your account. Now, as always, really appreciate you guys. You're the best. Have a great day.